Let's come back home to Nigeria and talk about our yields, which are rising on government securities around the world, starting a new year off to a new direction away from 2020, in which the stock market was the chief focus, right in the middle of a fast and furious fiscal spending, trillions of dollars. For Nigeria, the authorities have focused their debt drive on the local market and looking to woo and retain foreign portfolio investors moving forward. So let's get a chase the yield curve now as we bring on Wale Olusi, who is the head of research at United Capital. Good evening, Wale. Welcome to the show.
Good evening. Thank you for having me, Boason.
Well, thank you so much. We understand you're still in the office, so thank you so much for making the time. It's past 7 here in Nigeria. You ought to be on your way home. But let's talk about the chief drivers for Nigeria's yield curve across the general fixed income markets in the current week. What are you looking at?
Well, so far it's been mostly a liquidity issue. If you look at the overnight and the OBB rates so far between yesterday and today, they've been trading close to 10% or something above. So it looks like, except there are new maturities in the system, the size of liquidity are likely to drive yields generally higher. On Wednesday, we're expecting a Treasury bills auction to hold. What we've seen over the last couple of weeks is stop rates trending higher, and that has a way of generally affecting the secondary market rates. So basically, the direction of that auction during the week, the level of liquidity in the system, and a general expectation that the rates are likely going to climb higher. Those are the key drivers of the yield environment in the fixed income market.
But is the current depth of fixed income market trends of higher yields in line with your outlook at United Capital, Wale?
Absolutely. It is. I mean, earlier in the year, in January, when we published our outlook for the year, what we noted is that we expect that the low yield environment that we saw last year should reverse. Well, maybe what we didn't see is the fact that the pace at which it will reverse will be as fast as what we've seen so far. But we've seen a turn since December last year, and that has, continued. And I think we expect that to continue. And that has been largely what has been happening.
But are there any macroeconomic drivers on the horizon, near to medium term, that will impact our yield curve?
Well, a number of key metrics to look at, say the inflation numbers, for example. Currently, inflation for the month of January is around 16.5%. That's a big factor if you want to start comparing the real rate of return. Real interest rate or real yield in the environment, because at 16%, if you compare it to average yield, say even the 10-year bond yield, it's still considerably low. If you compare it to what the Treasury bills market is doing, is actually very, very low. So, the general prices in the system is a key driver to watch. The fact that dealers generally think that the yield environment last year, is something we've never seen before, is another factor to look at. Because what we've seen consistently is a situation where every time dealers go to the auction, they ask for a higher yield, the bid range is becoming wider, and that is generally driving the primary market rate higher. So the following day, when the market opened at the secondary segment of the market, what we see is a situation whereby yields, climb higher. I think the next factor is the fact that central bank needs to tighten. There is a concern around exchange rate and the need to stabilize the currency market. There is the need to attract foreign portfolio investors. And what we've seen recently is the central bank coming out to be a little bit more aggressive about OMO auctions. In the last couple of weeks, we've seen OMO on the 1-year OMO bill go as high as 10%. That's an indication. Once the central bank starts mopping up liquidity aggressively like that, market expects rates to climb higher, because generally central bank has two major tools when it comes to tightening the system. You can either use the monetary policy rate, which has been kept at 11.5%. But if you are not doing that, you may tighten, you may reduce the size of liquidity, the size of naira in circulation, and that's what the central bank has been doing. They've been mopping up, selling euros. And once you do that, you are signaling to the market that
just a quick one to wrap it up, Wale. What's your outlook on the Nigeria's Eurobonds, considering some recent global development? Where are we on that?
Well, I mean, I think the rally in oil prices we've seen so far is largely positive for Eurobond, and I think the yield on Eurobond has been, more or less. They've been improving. Because every time oil prices improve, the economic prospect for Nigeria improves. Foreign investors interpret it as we can definitely meet our dollar bond obligations. So there wouldn't be concerns at all. So long as that oil price continues to improve, we think is largely positive for Eurobond and, of course, for Nigerian sovereign Eurobonds.
And we thank you so much for your time this evening. Wale Olusi, Head of Research at United Capital. Thank you for your time and see you next time on this show.